Hey, good morning, everybody, and it is time for today's edition of Trader Talks in Today's Market. I know normally you're used to seeing Kevin Horner out. He's out today right now on a well-deserved break, and so you got me today. I'm happy to be here. My name is Brent Morse. I'm also joined alongside in the chat by Mr. Mike Fairborn, who's helping me out. So always appreciate to see you guys in the chat, and feel free to chat in questions between Mike and myself, and you got a whole group of willing participants there with you to interact with you. So I'm just glad you're here. You can follow Mike or myself on X, formerly known as Twitter, at BrentMooreCS, at Mike Fairborn CS. We got a whole bunch to talk about today. And yesterday was a big day in the market. We'll talk about some of that. We had Fed news yesterday, and the markets, especially over the last month, have been very interesting as well. Interesting sometimes is not sometimes interesting is not the best thing in the world for bulls, but we'll see on that. Let's take a look here at just a few disclosures before we get into the meat of the substance here. The information today is for general informational purposes only. It's not an individual recommendation of any security strategy or chart type. And the Paper Money software application, we'll be using the Thinkorswim desktop application, is for educational purposes only. I would encourage you to use Paper Money, though. It's a great way, it's a great learning ground without putting your real money at risk as you're learning new things. Past performance is no guarantee of future results. And Schwab does not recommend the use of technical analysis as a sole means of investment research. We'll be doing a bunch of technical analysis today as well. Just remember, investment returns will fluctuate and are subject to market volatility. So here's what I want to do. I want to start off with the S&P 500, which is where we usually start off in this class. And it's been a rough month. And I think the question is, when are we going to see a turnaround in this market? And is this a legitimate turnaround? And of course, nobody knows the future. This seems like a pretty strong low and a pretty decent bounce off the low at this point. So far this morning, we're down a little bit. But if you look here, there are, as you look at this downward move, what we've seen is a bunch of red days, green day, bunch of red, green, kind of interspersed. We actually see a more majority of green days so far. Now, today, it's probably too early to make any judgment on today yet. So that's kind of a good thing. If the market were to break this, that could be problematic. That is a low. And we've had, as we have gone down, we've seen they've been kind of rapid fire, but a lot of like little lows in here, new lows, and brief little lower highs as well. Well, here we actually have a higher high on this. That's a good sign. For a trend reversal, we do like to see that establish itself. So this would be an area to consider as we're doing that. And if we're going to look at this, I would also consider maybe using moving averages. We're well below our moving averages. This is a 20 and a 50-day moving average, by the way. Potential resistance? Yeah, moving average could be to potential resistance. We'll have to see on that. Another way to kind of maybe look at this chart, one that we don't really look at very often, is using Heikin Ashi candles. Here, are you guys familiar with Heikin Ashi candles? They're calculated a little bit differently. And I'm going to be putting a video out on X here in the next couple days on this. But you'll notice sometimes this can help you. Now, these aren't a perfect measure of trying to determine the trend, but they can help people with clarity, I think, in terms of the shorter term trends. Notice you got, instead of the green and red interspersed candles, you kind of have green and red and green and red. So the calculation on these candles is very different than the traditional candles. But you can see, and I'll show you where to find that in just a minute here. But with the Heikin Ashi candles, you can see we have turned green, and so that's probably a pretty good sign here in terms of a turnaround. But there's a lot of macroeconomic news and factors that can certainly sabotage this rally. No doubt on this. If you do want to look at those Heikin Ashi candles on your Thinkorswim desktop software, you can always go up to the gear up here, go to appearance, and where it says chart type, I'm assuming you may have candle there, but you could have anything else you want there. You can go and you can switch it to Heikin Ashi there. And when you do so, if you want to kind of read the calculation on each candle and how it works is, click on the little question mark, and it brings it up right here, and you can see how the close is, how the open is calculated, and so on there. So that you may find that helpful, but just realize you can't use this the same way that you would a normal candle in terms of trying to find what's red and what's green there. So I'm going to go back to my normal candles here, but I just wanted to let you know that is one way of possibly looking at the market. Now, one thing that has driven the market and has led the market down and led the market up are some of those bigger companies. Some of those like Mag 7 type companies here. But sometimes what we like to do is we like to see breadth in the market. And so what I'm going to do is I'm just going to bring up this chart of the percentage of companies in the S&P 500 that are above their 50-day moving average. Okay, they're above their 50-day moving average. So this is a percent. This would be 50% right here. And you can see we're below that. You can see the drop that we had when the market started to pull back to less than 30%, excuse me, below that. We have now creeped up closer to that 40% there. So Ricebird said the Mag 7 or the Lag 7. Yeah, lately they've been lagging, but the last couple days, they have actually picked it up, and that's helping to drive that market up. One other quick way to look at this is you can look at the SPX-EW, the equal weight S&P 500, and the graph looks pretty similar right now to the S&P 500. That's the equal weight. Here's the S&P 500. Either way, the market has been struggling there. Let's look at the NASDAQ. Here's the NASDAQ. And by the way, the SPX is down about 0.4% right now. NASDAQ's kind of right in line, about the same here on this. So kind of a mixed market. If we get a big rally, I'd probably expect the NASDAQ to outperform the S&P 500 if we get a big rally today. If we have a big down day, again, it's probably too early to tell. If we have a big down day, I'd probably expect this to underperform the S&P 500. And just to round it out, we're going to look at the VIX here. Actually, we'll look at the Russell 2000. And we're going to have a little bit more to say. This is more interest rate sensitive. This has been beaten up a lot more than the rest of the market. In fact, let's see what kind of pullback we had. From low to high, or from high to low, almost 20%. Now we've retraced a little bit on that here on this. Whereas when we were looking at that SPX, instead of that 20% pullback, let me get rid of that. We had from low to high closer to 10%. So the Russell 2000 really got hit hard as compared to the S&P 500. And sometimes, I guess what I would think is that my natural instinct is when the market gets hit harder, it recovers much more significantly. That's certainly no guarantee. If the market turns around, it's possible this Russell 2000 could continue to lag. Notice the Russell 2000 is closer to that 20-day moving average. That's a more relevant resistance point, a more near-term resistance point for that Russell 2000. The Russell 2000 is more concerned, I would say. So small caps are more reflective of a weakening economy, and that is a concern right now. Now, let's look at the VIX. So this is the implied volatility on the market. Some people will call this the fear gauge in the market. The higher this goes up, the more fear is reflected in the market. Well, when the market was tumbling, well, you could probably ask yourself, how were you feeling about the market a couple weeks ago, 1 or 2 weeks ago? You probably weren't feeling very good. Are you feeling a little better now? I suspect you probably are, maybe not, but you can see that reflected in the VIX there. The VIX actually, implied volatilities were actually falling before the market started to recover a little bit. And again, the recovery isn't a done deal. We could certainly reverse itself. But it shows that I think people are getting a little bit more used to this kind of uncertain situation in the market. Now, the big news yesterday was the FOMC meeting. I'm going to switch back to the S&P 500, and let me go to a shorter term chart. Let's go to 5-day, 5-minute here. Okay. So what we can see is, I'm going to zoom in, maybe we'll go to a couple days. So this is yesterday from here to there. Then you got the gray is aftermarket. Okay. And you can see we opened up a little bit lower today here on this. But here was the meeting. The meeting occurred right here in the day. This is when the rate announcement was given. And you can see, and then about a half hour later, you had Chairman Powell's presser was kind of right here. But you can see we had a pretty strong rally in the market. So what did they do? Well, they didn't cut. That was largely expected. This is the first thing. When Powell was talking, he said, "Hey, look, the labor market is okay." He didn't express any super big concerns, which has been more of a concern for people lately about the weakening labor market. That's been a concern. He said that seems to be okay. He has no particular concerns about that. He said the biggest uncertainty right now that they're facing, and he indicated that this is any forecast they're making, any interest rate forecast they're making is, of course, data dependent, is what they always say, is uncertain. And it depends what comes down the road. But he said the biggest uncertainty right now is surrounding kind of tariffs and the inflation narrative. So we'll see what it says. And we'll look at the dot plot here in just one sec to see, kind of what it's saying. But we did have a pretty strong rally here off that. I think, a lot of it was kind of, I don't know if best case scenario is best realistic scenario is kind of what I think the markets were seeing. This is the Fed Watch tool, the CME Fed Watch tool. This is not a guarantee of what's going to happen. Okay, this is absolutely not a guarantee of what's going to happen. But as Carol said in the chat, 2 rate cuts this year are kind of what the current projection is. You can see that on the dot plot if you want. So here's what the dot plot looks like. This is end of year, and this is where we kind of currently are right here. Each of these dots, if you haven't read one of these dot plots before, each of these dots is like a Fed member, uh, I don't know, vote is the word, but expectation of where interest rates will be towards the end of the year. The blue represents where the median projection is. So you can see two rate cuts here, and you can see going out to the end of 2026, two more by the end of 26. So in other words, the feeling is a gradual lowering of interest rates. Now, when we go back here, if you want, you can go here and you can kind of look and see the projections, but you can see the uncertainty as well. Right now, for the May meeting, current rate is 4.25. They're saying, roughly 15, 17%. I don't want to give too much precision on this, but about a quarter point cut. But most, the markets are projecting. This is based off Fed funds futures, staying put. But let's go here. Let's go to the end of the year. Let's go to December, and what you're going to see is a lot of uncertainty, aren't you? I mean, yes, this is where we are right now. So certainly expectations of it going down this year, getting cuts this year. But how much? Who knows? I mean, yeah, this is a 2 rate cut. Actually, this would be 2 rate cut there. The Fed fund futures market is actually projecting a little bit lower on that, but a lot of uncertainty, as you could see. So there we go. And so I don't want to belabor that. Let's move on and go back to the Thinkorswim platform. George says, last year Fed Reserve officials presumed that 2025 would simply be about getting to the soft landing. Not sure there's still thinking that's possible. I don't know if I think that's still their hope here on this. I think there's so much uncertainty right now. This is more uncertainty than I recall seeing in the market for an extended period of time right now in quite a while. I mean, certainly it's not more uncertain than the financial crisis of 2008, but it's been a lot of uncertainty about the future. And so John said, doesn't this kind of depend on other macroeconomic factors such as whether a tax cut occurs? Does that affect? Yes. Does the tariff narrative? Yes. What we see in terms of unemployment going forward? Yes. All those can certainly affect this. All right. So, but the bottom line is right now, in terms of what we're seeing and the reaction of the markets to this, this is the 10-year yield right here. If you're reading this, you just move the decimal point over to get the actual yield here. Nice little drop here. So that certainly benefits some people to see that drop. The concern is this. When we're looking at this, I think there's a lot of us who kind of want to see interest rates lower. That is certainly for those people looking to buy a house or refinance a house. That would be nice. It would help in certain other areas as well. Lower interest rates. Lower interest rates would probably help those small caps that are, in fact, not just small caps, but other equities as well, in their ability to finance debt and finance operations. But one concern is, remember, there's kind of two things that really drive interest rates, I would say. One is economic strength, and another is inflation. What we'd like to see is inflation going down, okay, continuing down, and that driving down rates. But if we see rates driving down too quickly, it could be a sign of concern about the economic strength in the market. So that would probably be a bad sign. Well, we'll have to see on that, but those are kind of two big things that can drive interest rates there in the market here. And just remember, why why would interest rates go down? Interest rates go down when there's more demand for bonds. If you look at a bond, let's take a bond future, ZN. We're not going to trade it or anything. We just want to look at what the price of bonds are. Let's do this. Let's go to /ZN. And before I click on enter here, look at what this chart looks like for the interest rate. Now look at the future. It's just opposite. So what does it mean that this price would be going up? It means there's more demand for bonds. More demand pushes up the price. Okay. More demand pushes up the price. Well, why would there be more demand? If people are more uncertain about equities, that can push up the price of bonds. And so that's going to lower the yield. So that's just kind of going to the point that rates, a nice glide path down in rates would probably be good. A strong drop in rates may be kind of a bad sign in the market. To further illustrate perhaps some of the market uncertainty is in the strength of gold. So here's the price of gold. That's an all-time high, folks, right there. We're above that 3,000 level, which, you know, those nice round numbers, 3,000, 4,000, tend to often act as kind of resistance levels or support levels. Well, we busted through that without too much of a problem here, but this could signal some uncertainty in the market. Now, certainly otherwise gold going up, there can be a lot of reasons. One is uncertainty in the market, talk of recession, uncertainty about maybe tariffs, just general uncertainty about economic strength can be something. Interest rates, gold is also bought not just by you and me, it is bought by other central banks around the world. And there has been more central bank buying of gold than in the past. And that is driving gold up further. One reason for that is some central banks are shying away from buying US dollars and instead opting to buy more gold. So that can certainly drive that up. But right now we're at an all-time high, and if we're doing kind of a trend analysis on this, you'd have to say that's a pretty stellar trend on gold right now. Any sign of it weakening? Not in my mind. I don't see any weakening here. Of course, I don't know for sure. Things can certainly change very, very quickly. Carol in the chat said, I read that Powell stated he feels any inflation due to tariffs should be transitory. In his presser after the announcement, he was asked, and basically he was kind of challenged on the idea that, hey, you guys thought inflation was going to be transitory back with COVID, but you guys were wrong. It wasn't put exactly in those words, but that was the gist of the question. And his response was, well, this is a little bit different this time. So he does feel it's going to be, he does feel it is a different situation this time, but he did indicate he is still concerned about inflation. Now, that's gold. And of course, often when we talk about gold, we talk about silver. So silver, you can see kind of a similar trend to gold. Of course, silver has more industrial uses, but either way, precious metals are a source of strength in the market right now. Now, something that is not a source of strength in the market right now is oil. Okay, so here's oil. This is light sweet crude oil, and just not a lot going on with oil. I mean, the general trend has been down, but it does seem like it's hit a level lately where we've mellowed out a little bit on this. Be interesting to see. Let me go back to a little bit of a longer term chart here. Let me go back to a year. I don't know what that line is there. Let me activate. That may be going back to longer term. But what I'd say right now is this seems to be probably more of a support level in here where we're at. We'll see if we break that. That would be could be a significant break on oil right now. But there's not a lot changing in terms of supply or demand on oil. What would drive oil up? Well, one thing that would drive oil up would be just a strong economic forecast would drive oil up. But there's enough uncertainty right now that I don't think we're seeing that. Now, sometimes what we do is we ask ourselves, what is the correlation between oil and things like the markets or things like the dollar? So if you look at the dollar, I'm going to use DXY for the dollar, you can see the dollar has weakened a lot lately. So people will ask, what's the correlation between the dollar and, say, interest rates? Okay. Or the dollar and gold, or the S&P 500 and gold. Well, you can do that. If you go up to your studies, go to Edit Studies, and let me get rid of these guys right here. And I'm going to go to correlation. You just type in correlation. You can bring that up. And it's going to bring up a study. You can see that right down here. And the study is going to be, it goes from 1 is the upper end it can be. -1 is the lower end it can be. And 0 is kind of midpoint. 1 would mean kind of perfect positive correlation, okay, between whatever two assets we're going to talk about. And we'll get to that in just one sec. It means if one goes up, we're going to expect the other one has gone up. This is backward looking, of course, has gone up. Now, of course, it's going to be a wiggly line. It's not always going to be, it's not going to be a straight line. A -1 means historically when one has gone up, the other's gone down, or when the other one's gone down, the other one's gone up. And 0 means they're just kind of independent of one another. So let's take a look at this study here for a sec, because what I wanted to do is I mentioned the dollar. And so what I'm going to do here is I'm going to go up and I'm going to edit the study. Notice the default on the study is the S&P 500. And I'm going to put in the dollar here. I'm going to put in $DXY. Okay, so that's our dollar index. I'm going to click on OK. I'm going to click on OK. And let me do this and just kind of look at dollar versus, say, gold. Oops, GC is gold, okay? So this is gold and the dollar. And so sometimes we get in this habit, I think, of saying, well, when the dollar goes up, gold is going to do something or other. Or when the oil goes up, when the dollar goes up, it's going to affect oil in this particular way. This is a way of kind of testing it out for yourself. Now, in certain times of the market, correlations are different. So for example, let me go to a 3-year chart here on this. Now, the way I would look at this is this. Pick out your 0 point on this. Here's my 0 point. And by the way, there's a survey link in the chat. We always appreciate your feedback there. So here's the 0 point on this. Are we spending, forgive my line isn't going to be perfect because I'm hand drawing this with my mouse here. Are we spending more time above the line or below the line? Well, we're spending more time below the line right now. So over, we'll say the last 3 years, then it's certainly been more negatively correlated. More, not always, right? I don't want to overreach here on this. It's been more negatively correlated to the dollar than it has been positively correlated to the dollar. Well, let's check another one here. Let's check, instead of gold, let's check oil. Okay, so GC, we're going to go to CL. Here's oil, and this is, again, this is a 3-year chart. Where's our zero line? Let's see if I can draw this. Here's my zero line on this. There's my zero line. Certainly over the past year or more, very positive correlation between oil and the dollar. Before that, it was actually more negatively correlated for a while. So here's my point. My point is, sometimes you hear kind of pat answers of, hey, the dollar and oil are going to be positively correlated or something like that. They're going to go the same direction. I want you to think about that with a little bit more of a discriminating mindset on this, and just realize that is not always the case there on that. Okay, so let me just see, is there any others? Now you can always change this, by the way, and you can say, what about interest rates and the S&P 500? Okay, the S&P 500. So Mondi 5 says, wouldn't it be better to use a comparison study? Here's the challenge. The challenge is with comparison study, and the comparison study is great. There's nothing wrong. And I use a comparison study all the time. But sometimes what you do is you get two things that are kind of going up, or they go up and down over different periods of time. And if you use a comparison study, I find it's difficult to see kind of when it shifts for a little while, just the overall picture for a little while. But you can certainly use whichever one you want. So it's certainly using a comparison study is a way to do it. That's nothing wrong with that. You can certainly use that comparison study. I use comparison studies all the time, by the way, there on that. All right, let's, and just a reminder on this, if you want to do this, if you you can go to your studies. I added correlation. If you want to, of course, comparison is a study that you could add there. But if you want to change this, the default is going to be the SPX. Go to the gear, and then what you can do is you can say, well, look, I want to the this is going to be the normal SPX. Okay, we're going to make that SPX. And then if we want to see like interest rates, we can do TNX : CGI. Okay, and so you go, and this is definitely a much more mixed picture. Here's my zero line, if you can see my cursor there. And you can see of late, it's been 50-50, okay, correlations there. So it's not a strong correlation. Now, let's move on from that. Let's go back and let's talk about, we have some big companies, some larger companies' earnings today coming out after the market closed today. One of those is FedEx. Okay, here's FedEx. Now, FedEx is probably, I'd say maybe the biggest of them, because FedEx is often seen as kind of a proxy for the market. In other words, where do they get their business? They get their business, FedEx, from shipping other people's stuff. And if people are shipping a lot of stuff, that's a good sign of economic activity. If their business goes down, it can be considered kind of a sign of general, a lower forecast, so to speak. So remember, it's not going to be just what their earnings have been. It's going to be what their forecast, 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 what their forecast is there on this. Because right now, the trend has been, well, look, I mean, it's been a downward trend from kind of late November until now. Lower highs, lower lows. We'll see if that turns. This is just a company that is a big one. That's coming out after the market closes today. That's one to consider. Other kind of biggest names coming out today, later with earnings, Lennar. Lennar, again, same story. Trend is down, and we'll see if we get any significant changes on this. Micron is coming out with earnings after the market today. Micron has been kind of, from a technical standpoint, I guess this is what kind of catches my eye here, is we got this. That's been the general. In fact, we had this kind of island gap there, but this is generally what we've seen from Micron. When you're doing support levels, resistance levels, any technical analysis, of course it can change at any time. There's no guarantees of that. And as we always say in our disclaimer, technical analysis isn't the sole means of investment research. But the theory on technical analysis is what's happened in the past is going to repeat itself. Well, it doesn't always repeat itself, right? But it's kind of all we have to go on in technical analysis typically. But the times it tends to break through support levels or through resistance levels or indicators change is earnings, very often on earnings. So if we're going to break above that trend, this may be the earnings announcement. Of course, that's in the semiconductor space, and there's it's not the biggest there, but it's a biggie, Micron. Let's go to one other kind of big household company name that's coming out with earnings, Nike. Poor Nike has languished over years now. It's really had a couple of really tough years right now. But in fact, let me go a little longer term here just to kind of illustrate. Let me go to the 3-year chart here. Here's Nike, longer term. You can kind of see, this is a weekly chart. So this would be a 50-week moving average. 50-week, what's a 50-week moving average? That's equivalent to a 250-day moving average. So that's a long-term moving average. We'll have to see. That's right where we are right now. You can see the general trend has been going down on that as well. We'll see if if we can break out of this kind of malaise, so to speak, on Nike. They've faced increased competition of late with Nike there on that. Okay, a couple more stocks I want to talk about here that are in the news today. One is Southwest Airlines. That's been a pretty good run, hasn't it, in Southwest of late? Before the move we've had recently, I probably would have said this was kind of what we had. And then we had a breakout. Breakout kind of came down, tested and bounced, and now it's been going strong. Probably potential resistance up around that level, I'd say. And so what's happening? We don't have earnings on Southwest. We're up 1.5% today. Why am I mentioning it? I'm mentioning it because it was upgraded by 2 separate analysts. UBS upgraded LUV, or Southwest Airlines, from a sell to a neutral rating. They upped their price target. Now, this is kind of interesting. From $29, that was their old price target, to $36, which frankly isn't that far away right now. So they're giving that a neutral rating. Okay. So all the ones before this that I just mentioned, Lennar, Micron, Nike, and FedEx have earnings after the bell today. Okay. Yeah, that's the thing. No more free bags is what Jim said. Then that's been my daughter just flew Southwest. She got in, I think it's May is when they're going to say, yeah, no more free bags at that point. I said you got in under the wire before they changed their policy on that. So let's take a look at the other analyst rating Southwest. Melia said, "Hey, we're upgrading this from a sell to hold." Their price target was the old one. These price targets are kind of funny to me, to be honest. The old one was 28. That was their old price target. They've marked it up to 34. Okay. Which, in my mind, if your price target is 34, now I don't know what Southwest is going to do. It certainly may go up more. It may go down. I don't know. But if indeed you have a price target of 34, in my mind, I'm thinking, and I'm allocating capital, I'm going to say I'd like to put my capital into some stock that I have a higher price target on than what the current price is there. Okay, so there we go. There's one other company here that just had, well, there's obviously a lot of companies that have upgrades and downgrades on any given day, but Rivian, this is another bigger name here. This is one that was actually downgraded. Piper Sandler downgraded Rivian to neutral from overweight. Their new price target is 13. Okay. It was $19. Okay. So that's anytime you get a downgrade, that doesn't help the stock. Down 3% today on that news there. Okay. And there we go. Let's just kind of wrap up what we talked about today as we're finishing up here. And a reminder, of course, make sure you subscribe to that Trader Talks channel, Trader Talks YouTube channel. If you've already subscribed and you see the subscribe button, don't click on it again because you'll unsubscribe. But by subscribing, it gives you access to, it moves it up in the algorithm, so to speak. You'll be able to find that channel. You'll be able to find the content that is of interest to you. Also, there's a survey link in the chat that you can, we appreciate your feedback on that survey. Now, what did we talk about? Well, we talked about the major indices. We talked about the S&P 500. And is this a meaningful reversal? Right now, it seems like this is certainly different than what we've seen before. We looked at Heikin Ashi candles as a possible means of trying to help us out on that. We looked at support and resistance levels on that. The other indexes are looking fairly similar. The other major indexes are fairly similar. Volatility is dropping on the market. Interest rates are dropping. Gold is flying high. Oil, not so much. And we looked at an indicator, correlation, that may help you as you're trying to find out how one asset class compares to another. Appreciate y'all coming up later. That's at, let's see, today is Thursday. At 11 o'clock Eastern time is Long Verticals. Make sure you check that out. Thanks, Mike, for helping me out. Everybody, have a wonderful rest of the day. Bye-bye.